Barrera with the Investing News Network, and here today with me at BRIC is Keith Schaefer, editor and publisher of the Oil and Gas Investment Bulletin. Thank you so much for joining us today, Keith.
Priscilla, thank you for having me.
All right. So after OPEC announced last year that they will be cutting production, there were many talks about whether they will actually comply. Currently, it looks that they are complying. Do you think that that will continue?
I think it will continue. Maybe not 100%, but I think it will continue. The market is telling us that it will continue with higher oil prices here. But these countries really hurt over the last 2 years, a lot more than they thought they would, particularly Saudi Arabia. So Saudi Arabia has really signaled to the world that they're willing to cut even more than they said they would if it meant keeping oil prices higher. They're a despotic government. They are a kingdom that's a minority. They need to keep social peace, so they need higher oil prices. It's that simple. For them, it literally is do or die.
Okay. And as you're mentioning, there were actually other talks about OPEC cutting further their oil production. Do you see that happening?
Yes. Well, and OPEC is playing a great little game here, a very smart game. What they're saying is we're only going to cut production for 6 months. So what that means is that in the futures market for oil prices, if they said, okay, we're going to cut now for the next 2 years, the price of oil would skyrocket, and the futures price for oil would go even higher. The street would price in much higher oil prices, which would allow the U.S. shale producers to hedge their production and lock in profits at progressively higher prices. That's the last thing OPEC wants. OPEC wants the future price of oil to be very low so that U.S. shale producers cannot lock in good profits, and they always have to kind of be on their toes. So they're going to keep rolling over these cuts, but they might say, oh, it's only going to be 6 months, or it's only going to be 3 months. That's what they're going to say all the time to keep the futures curve low. So they are going to keep doing production cuts, even though they say they're not.
Yeah, and as you're talking about this, OPEC is not the only participant in the oil space. We also have the U.S., which is bringing more production into the market. Do you think that's going to affect the balance in the market?
Oh, it's absolutely going to affect the balance of the market. What the U.S., and really when we say U.S., we also mean Canadian, but the U.S. is a big player. The U.S. has shown that they're very nimble in their production. They can raise it and lower it incredibly quickly. They're very, very efficient. So much more efficient than anyone really gave them credit for. So yes, I would expect that U.S. production is going to rise actually quite a bit more quickly than most people would expect in the face of higher oil prices.
All right. And what would you tell investors hesitant to get into the oil market?
You know, my attitude is if you get a hunch, you buy a bunch, and then you just keep your stops tight. So let's say you like an oil stock, you think it's good, let's say it's trading at $10 a share. You just buy a small position at $10 a share, and if it trades down to $9, you sell it. Because the market's telling you made a mistake. So you just don't bet a lot of money, you just start to learn by investing slowly, and hopefully you pick the right ones.
All right, and what companies are you watching right now, and what do you like about them?
Probably our one we like the most right now is a company called Resolute Energy. So this company has done fantastic, both in its production and the stock. The stock has gone in the last 5 months from $3 a share to $45 a share. And you might think, oh, it's had its run. But the reality is that this company is producing so much oil so fast, it's increasing production so fast, I think the stock's going to $150. And it is in the sweetest spot of the Permian Basin down in southwest Texas. They're getting 5,000 barrel a day wells that they're choking back to 3,000 barrels a day. There's almost no declines on the wells and compared to a typical shale type curve. The other one we really like that's quite a bit cheaper is a company called Select Sands. They're a frac sand company. They trade about $1.80 on the Toronto Venture Exchange. And they're developing a new frac sand mine. They've got They've just bought the asset. They've raised all the money. They're just putting it into production right now. And they're fully financed, so that makes a big difference. They have all the money they need. So that's one more expensive one and one cheaper one.
All right. Thank you so much for joining me today, Keith.
You're welcome, Priscilla.
Once again, I'm Priscilla Barrera with the Investing News Network.